Hey, everybody. Welcome back to the Hilton True Wealth Podcast, the show where we explore the ideas, strategies, and conversations that help people build meaningful, lasting wealth, not just financially, but in life. I'm Mark Miller, manager of the Hilton Family Office and CEO of Hilton Tax and Wealth. Today, I'm joined by Jason Plusanak, senior investment advisor at the Hilton Family Office. Jason has over 20 years of experience in investment management, specialty finance, and operations. We'll be discussing why traditional models of investing are not working as well as they used to, and better ways to invest for the long term. So, Jason, welcome.
Thanks for having me, Mark. Happy to be here.
Well, great. First, give us a little idea of your background.
Sure. Started my career 20 plus years ago in life insurance, security sales, etc. In my mid-20s, I was able to join a family office specialty finance company run by a family office in Minneapolis, Minnesota. Spent about 10, 12 years building that specialty finance company, creating investments, working with the SEC and the regulators, distributing proprietary investment products all around the country. We ultimately raised about $1 billion from scratch. Was able to take that company public on NASDAQ in 2014.
That's awesome, yeah.
After that, I actually met Mr. J. Bradley Hilton about 6-7 years ago and got to work on a small private equity firm in Florida with a few partners, Brad being a part of that company. So I spent the last 5-6 years helping build that small private equity company, focusing on real estate development, again, building investment securities, working with the SEC, raising capital, raised nearly $100 million for that firm. We did direct list that firm onto the public markets as well. And as of late, I've been working very closely with Mr. Hilton from a senior investment officer position.
Absolutely. Yeah, that's great. So you and I have a little bit in common, at least how we started, kind of insurance. I worked for that small little company called American Express. But I ended up in Minneapolis also, in Minnesota, doing training there, I remember. And so I kind of started my career in that world too, and then got in brokerage over time too. So we have a little bit in common that way. But obviously you have a lot of experience in the investment world, and we're interested in kind of tapping into that experience today as we talk today.
Happy to chat.
Absolutely. So in the book Hilton Wealth, How to Invest Like an American Dynasty, we kind of argue that the traditional 60-40 model really isn't able to deliver what it used to deliver, even though a lot of retail houses and brokerage firms still use that model. Let me ask you, it used to be the gold standard. Why do you think that it has changed now and it's not so much the gold standard and the best way to invest?
Well, the market has changed.
Yeah.
It's important to understand the financial conditions and what was going on in the world when 60-40, market portfolio theory came to be, and when it was popularized. The market just is not in that condition anymore. Right. There's so many other factors that affect it, whether that's globally or advancements in technology, et cetera. 60-40 is great if you don't care much about the outcome. But if you care about the outcome, which most people do with their portfolio, there's better ways.
Yeah. And I remember first kind of being experienced in the early 2000s when I had a firm. And of course, the dot-com, during the dot-com bubble, things were exploding. And everybody thought they were so safe with that 60-40 model. And that was the first time when both stocks and bonds went down together, and people were absolutely shocked. I mean, even in the investment industry.
You nailed it. You nailed it. What I was referring to in regards to market structure, when 60-40 became popularized, there were two key components that have changed since about that time. One were that stocks and bonds were reliably negatively correlated, right? Two is we were generally in a low inflation and steadily decreasing interest rate market environment.
Right.
Are either of those things true today? No.
Yeah.
No. So the two key factors that really contributed to 60/40 offering diversification becoming popular and a decent way to manage your portfolio, the underlying market conditions and structures changed.
Yeah. And what I find fascinating, but understandable, is on the retail side, most of the brokerage firms, the Fidelities, the Vanguards of the world, all that, even in their portfolios, they're still preaching the same thing. Now, I have my own theories on that. I kind of believe it's because it sells. It's easy.
I was going to say the
Yeah.
same. I was going to use not as nice of a word.
Yeah,
I was going
yeah,
to say it's lazy.
yeah. Oh, that's true.
But it's lazy and it sells. Yes.
Yeah, and it sells so they still can bring money on board with that quote philosophy. But what scares me right now for so many people out there, and probably a lot of you listening right now, is you have maybe a version of that 60/40 model. And but what I see a lot of clients that I work with is more like the 70/30 or the 80/20, because over time, because the markets have exploded so much over time, more and more money has gone into the equity side and has exposed them even more.
Yeah.
So,
Yeah. I mean, and that brings up other, portfolio management tactics such as rebalancing and things of that nature.
yeah, absolutely. And so, we talk in the book Hilton Wealth about low volatility investing. So a lot of investors assume that lower volatility, meaning not being so much on that roller coaster, is just not going to give you any returns. Why is that often not true?
Well, first off, I think it's important to address that most investors think that volatility and risk return are the exact same thing.
Yes.
If it's low volatility, it has to give low returns.
Mm-hmm.
And while that's true in some cases, there's plenty of examples where low volatility investment offer lower overall returns, but that does not mean those two concepts are analogous.
Yes.
There are plenty of unique, alternative, esoteric investment opportunities that have lower volatility but still offer the asymmetrical upside and return profile.
And the thing is, and I talk to people about sometimes in higher risk investments, volatility can be your friend. Okay. Volatility is a good thing. Like, people are shocked if they're in a commodity or something, or if they're, a lot of my clients ask about Bitcoin now and they're like, oh, but it's so volatile. It's crazy. It's going up and down. Well, that gives opportunity, but it's about risk management. If you take all your money and put it in a highly volatile investment, well, yes, of course, that's crazy, and you're going to end up probably not in a good place. But it's about risk management. It's about balancing and all of that, like we do with the True Wealth portfolios.
Exactly.
Yeah.
Exactly. And, you also bring up a good point in regards to high volatility that wasn't mentioned, but it was inferred. High volatility products bring in emotional and behavioral decision making.
Yes.
And that's generally an issue
Yes.
when it comes to managing one's own portfolio. Of course, at the Hilton family office and with True Wealth portfolios, we have a very systematic approach with risk management systems.
Yeah.
Very, very organized, researched, and we try to eliminate the emotion and the behavioral aspects of decision making, of course.
Yeah. And so why do you think that wealthy people, why do you think that they prioritize more consistency and less kind of that roller coaster ride? Why did they do that?
Yeah. Well, once you get to that point, you got more to lose.
Yeah.
That's the first thing that comes to mind. You
Yeah.
have more to lose.
Yeah.
But also, you start thinking at a higher level. You stop thinking about just making a few big wins, and you start thinking about legacy. And where and what you want your wealth to do for you and your family
Right.
on a longer term basis. And that consistency then outweighs chasing those big gains.
Yeah. Yeah, I think that that's a big thing that I find is like the wealthier that somebody gets, the more important it is to start thinking about safety and security. And again, it's just the opposite of, how retail investors might think. And, specifically talking about the portfolios with the Hilton Family Office, the managed money portfolios. I think that is, even though kind of that's one portion, a lot of those can be an at-risk portion of a portfolio. There's still an emphasis on some balance there.
Mm-hmm.
I mean, talk a little bit about the managed money portfolios and kind of what the philosophies are there and how those work for folks.
Yeah, when it comes to managed money portfolios, we're really looking at increasing upside return possibilities with protecting downside.
Mm-hmm.
It's all about risk management.
Yes, yeah, we're talking about.
Yeah, it's all about risk management.
Mm-hmm.
Of course, we want to find assets that offer unique value and or asymmetrical upside, but we are always protecting against the downside.
Mm-hmm.
Because especially with those larger portfolios, it's more about the return of the money than the return on the money. Particularly thinking about legacy and generational wealth, if you will.
Right. So if you looked at the things to prioritize, building a more modern portfolio today, we are in a different economic circumstances than we were 20 years ago, 40 years ago, 60 years ago. Mm-hmm. Things change, right? Mm-hmm. So what should investors prioritize much? Should it be returns, risk management, tax efficiency? What would you say is the maybe 1, 2, and 3 that they should be focusing on, the order of those maybe?
1A, 1B, 1C.
Yeah, yeah.
Yeah, I of course, we always want to get to know client relationships at an intimate level, financially and goal-wise, but everyone's different, and you really can't discount, returns over risk or risk over returns, or tax efficiency over another. You got to take the whole picture into account and maximize all factors.
Right. One of the things that I love what you're focusing on in the portfolios is maybe more of a tactical approach to, and not necessarily, and again, different things for different people, but being tactical rather than just saying, hey, we're going to be rigid and say, this is going to be your portfolio. Here's how the structure is going to look and what it's going to look like for the next 20 years. Again, that goes back to kind of the retail mindset. It's just like, hey, set it and forget it. Mm-hmm. In reality, the wealthiest, the wealthies don't do that. They do have more of a tactical approach, right?
Absolutely. Yeah. The key is balancing time horizons and your risk management matched to those time horizons. Mm-hmm. So even within a managed money portfolio, you can even have separate buckets with different time horizons within just the managed money bucket.
Right.
Which then offer diversification, balanced risk return profile, risk adjusted returns, things like that.
Sure. In Hilton Wealth, we talk about the 4 buckets. Mm-hmm. The first is that capital preservation bucket. Then there's an income bucket. And then there's a managed money portion of the bucket. And then finally, alternatives, private equity, which that's what people are most excited about, right? But that's generally a small part of the portfolio, but can make a big difference, obviously. So when it comes to diversification, allocation, explain kind of the difference between those things and kind of what our approach is on looking at that in different asset classes.
Yeah. Well, primarily diversification pertains to asset classes and not having too much beta in a portfolio. Essentially, you want...
For those that don't understand, what is beta? For those that are listening and don't get
correlation. correlation.
Right.
So if an asset class is going up, you would want another not as correlated and to go up in lockstep.
Got it.
For layman's terms. So we're looking a lot at correlation, and in regards to diversification, we don't just look at asset classes. We look at geography.
Yeah.
And many other factors that help diversify among, not even geography and asset class, but product structure. Some people wouldn't even think that you'd want to diversify within product structure. But when there's different terms of liquidity and when you can get your money out of certain investments, or have options to get your money out of certain investments, everything we deal with in the Hilton family, as you know, is not just stocks and bonds. There's very unique direct investment structures.
Yeah.
And those have different liquidity profiles, whether we need to commit funds to a more direct project for a certain amount of months or years. So all of those factors factor in when looking at the managed money profile.
Right. You know what I love what we're doing at the Hilton Family Office is also when we go into alternatives, we're looking at backstops. In other words, a lot of people that don't necessarily know better, and even know better, but are just willing to take the risk, are in private equity alternatives, kind of in a naked position, meaning, hey, that sounds great. I mean, I got pitched the other day on it because we do a lot in the movie business and executive producers and a bunch of movies, and for the tax purposes and equity side and all of that. But I got pitched on a movie the other day. Hey, this is going to be the best movie and the greatest movie. It's going to make a ton of money. Just put your money in there and let's hope it does well. And it's a great movie and has incredible actors, directors, and everything in it. But we would never go into that in a naked position, which and that's true with pretty much all our private equity type of investments and alternative investments, right?
Yeah. And we are fortunate to be able to negotiate those kind of assurances.
Yes.
Investment sponsors also see value in having the Hilton Family Office involved in their projects. So we're fortunate to be able to get some unique product structure assurances, things like that.
Yeah.
But also, it's important to us. We need collateralization and or other backstops, like you said.
Sure. And what I would say to everyone out there is if you've been pitched on some kind of private equity deal or something I think honestly the worst thing that happens is you see a pitch on TV and then you go research that and it sure looks good. Well, they've designed it to look good. I think that most people should look deeper, and also just really, it's tough. Let me just put it's tough if you don't have access like we have access. It's tough to get that and demand that kind of backstop.
Absolutely.
But that's what we talk about that in meetings all the time. And even when we're talking with issuers for the first time, we're always like, hey, just so you know, our model is we're not going to lose our clients' money. And some issuers are like, well, that sounds weird. Mm-hmm. Well, no, just give us, $50 million and haven't you seen our track record? We're going to do great for you. Mm-hmm. So I think sometimes in meetings, it's a little bit odd for folks to hear that. But, I think in theory, everyone would be saying that as I don't want to lose money. Of course. But there's a difference between thinking that in theory, I really don't want to lose money. Am I going to lose money in this? And asking the issuer that, or whoever is doing the offering, and is there something structurally built into it to where that is in fact the case? That's not going to happen.
Right. So that's exactly right. And most of my experience that we chatted about earlier with the specialty finance companies and the private equity, they revolved around prospectuses and investment products. Yeah. So, we as a team are uniquely qualified to truly understand what's promised and what's legally promised.
Yeah. And what we can deliver ultimately, and structuring things so we know exactly what we can deliver to the clients. That's a big thing. So for someone looking for what might a portfolio look like for somebody that is more looking for a capital preservation kind of program or portfolio?
Yeah. Well, we're going to primarily focused on guaranteed fixed income assets.
Yeah.
Diversify across different issuers, of course. We all believe in the great United States government.
Yeah.
But there's certainly benefit in diversifying across various fixed income assets. Also, depending on time horizons, even if you have a very low risk tolerance, if you have a time horizon that can withstand some illiquidity, we can look at some unique alternative investments that offer fixed income, are generally locked up, so they have a little longer term time horizon, but are fully collateralized, have that backing and assurance that you were talking about earlier, Mark, and still offer a great fixed income return.
So let's talk a little bit about the future. What changes are you seeing in wealth management in the future?
Well, I think we're going to see
now or in the future.
Yeah.
Say.
We have been seeing this, but I do think we're going to see this continue. Is the rise of do-it-yourselfers, pretty much due to advances in technology, AI programs, and things like that. So I do think that will continue in the future of more do-it-yourselfers trying to.
Is that a good thing or a bad thing, or maybe a double-edged sword?
Great question.
Yeah.
Could be either.
Yeah.
But if history tells us anything, net bad, it will be net bad. And here's why. Because advancements in technology and AI offering all these things for people to do their own and manage their own portfolios, it's not going to change human behavior. And the reason do-it-yourselfers generally do not keep up from a portfolio standpoint is because of human behavior, psychology, and emotion-based decisions that many think they don't get roped into, but when things get real, it happens. We're all human.
Yes.
It happens.
Yeah.
So that's one big thing I see in the future. Of course, digital assets, the whole crypto and blockchain industry, I think is going to have a meaningful change looking forward.
Yeah.
One aspect that comes to mind really is, and I've been following this, is the ability for stable coins to offer yield in a compliant, massively available way.
I think that's why they're arguing in Congress right now.
Banks
that.
are, yeah.
Yeah, the banks want all they want all the control on that deal.
Banks don't like that much, but we'll see what happens with the Clarity Act.
Yes.
That certainly could have a ground shifting effect in financial markets going forward.
Yeah, absolutely. I had a great conversation with one of my very wealthy clients the other day about this, about the emotions involved with investing. And we kind of went back in his history, and he just talked about all of the sleep that he lost over the years. Now, ultimately, he came out good on the back end. He had a really good company that generated incredible cash flow. He sold out for a big number. And he got very fortunate in that, but he said it was like so many sleepless nights, enough worrying about his business, but he was also worried about his portfolio because, again, he was in a standard portfolio and his broker just kept saying, write it out. And he told me the story about waiting for 4 years. And I can't remember what years he was talking about, but maybe it was around 2008 or something, waiting around for 4 years for his money to get back to even, back to where he was.
Wow.
And how at the end of it, how angry he was because he had lost so much sleep, and he and his wife had, talked about it almost more than they talked about the running of their business. He'd kind of stepped away from the business, was kind of running itself. And here they are doing this DIY. Yeah, absolutely, of their portfolio, which again, I think is just, problematic at times. So, so anyway, that's That's some good points you made. So, if someone wants to build wealth to last generations, what would you say is the most important principle that they should be focused on?
I think the most important principle is that of a team. It takes a team. One is none,
Mm-hmm.
right? Specifically, you said generational wealth. I mean, building generational wealth takes a generation, right?
Yeah.
And in order to do that competently, you need a team. It cannot be done alone. Of course, there's outliers, but by and large, it takes a team, and you need to find that team of experts
Yes.
and people you can help build that generational wealth.
Yeah, it is a team effort. I mean, it's one of our things with Hilton Tax and Wealth Advisors, which is a spinoff of the Hilton Family Office. It's basically taking those family office concepts, which I'm sure there's family office people listening today, that we have a team of everyone that is massively communicating. It's not just you have different advisors that don't want to talk to each other because they are afraid that they'll, lose the business or whatever. It's everybody really truly working synergistically together
Right.
to help build that wealth and help build that ultimate legacy. So that brings us to the end of today's episode of Hilton True Wealth. If you want to learn more about topics relating to building your wealth, tax planning, cutting edge technology, and family office services, we're here to help. A huge thank you again to Jason for joining us today. Be sure to follow us wherever you get your podcasts so you never miss an episode. And if you are curious to learn more about your wealth, tune in every Friday for new insights and special guests. If you found value in what you heard today, share it with someone who might benefit too. For more insights, resources, and to get a free copy of our book, Hilton Wealth, How to Invest Like an American Dynasty, visit us at hiltonwealth.com. Thanks for joining us today. Until next time, keep learning, keep growing, and keep building your true wealth.